Warren Buffett is one of the most famous and successful investors of his generation. According to Buffett's 2021 letter to the shareholders, he has averaged returns of roughly 20% per year since 1965. Compare that to the returns of the S&P 500 during that same time period of roughly 10.5% per year, and Buffett's results are astonishing. He's essentially doubled the long-term returns of the market over his investing career, and while producing those kinds of sky-high long-term returns ourselves is incredibly unlikely, many still search for metrics and insights in the hopes of getting as close as they possibly can. One such metric rose to prominence when Buffett called it the single best measure of where valuations stand at any given moment. He did later walk that comment back, saying that he was hesitant to endorse any single measure as either comprehensive or consistent over time, and if you've been following this channel for a while, you'll know that that is with good reason, as precious few valuation metrics have shown really any ability to consistently predict market movements over time, but still, the metric does remain named after him and is still widely followed. It's known as the Buffett Indicator, and while I don't anticipate that this metric will be able to consistently predict future market movements either, I do think it would make for a good case study to answer a question that's been on my mind the last few times I've been covering investing metrics. And that's, why don't they work? So that's what we're going to be talking about today. Let's discuss the Buffett Indicator, what it is, how it's calculated, and how reliably, or unreliably, it manages to outperform the broader stock market historically. And of course, why it and other metrics like it struggle to consistently provide reliable signals for investors over time. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So first things first, what is the Buffett Indicator? Well, the Buffett Indicator is simply another stock market valuation metric that attempts to quantify how costly the stock market is relative to some data point. Originally in 2001, when Buffett proposed the metric, this data point was the US GNP, or Gross National Product. However, over the years, that data point has become less widely used. Today, the most common data point to use is the US GDP, which is generally more easily accessible to everyday people and rarely deviates from the Gross National Product by more than a few percentage points. The theory behind the metric is that through it, we'll be able to see signals when stock values diverge from corporate profitability, the growth of which is often correlated with the growth of the US GDP. When stock values rise faster than corporate profitability, we can expect that in the future there will be some sort of reversion to the mean, and stocks will experience lower returns until the gap between their valuation and corporate profitability is more or less back in line. And the same is true in reverse. Again, this does not mean that the metric is capable of predicting short-term market movements, it just explains why it's been used as a valuation metric historically. Calculating the Buffett Indicator is fairly straightforward, as it's just a measure of the capitalization of the stock market divided by the US GDP, with the result being multiplied by 100 to convert to a percentage. Some people use different indexes to find the capitalization of the stock market, but that's the basic formula. So say that I wanted to use the Wilshire 5000 Total Stock Market Index to calculate the size of the stock market, which, at least at the time of this recording in August of 2022, is around $41 trillion. I'd take that value divided by the current US GDP, which, according to the Federal Reserve Bank of St. Louis, clocks in at around $24.85 trillion or so, although keep in mind this is just an estimate and could change over time, and I'd find that the Buffett Indicator reads roughly 165% or so. That's higher than the long-term historical average for this metric, but certainly nowhere near all-time highs, and it has come down quite a bit this year. So that's the basics behind the metric. Now let's turn our attention to how useful it's actually been for investors historically. When it comes to examining the historical efficacy of the Buffett Indicator, there are a couple of things we need to keep in mind. First, GDP is a lagging indicator. We don't know for sure what the GDP is on any given day because it takes time to gather that information and then for the results to be published. Therefore, any metrics that use it are either going to be at least slightly outdated by the time they're published, or are going to have to come up with some sort of estimate for that portion of the formula, which means they may not be 100% accurate at the time they're published. And second, the Buffett Indicator has been rising over time, particularly since the mid-90s. You can see what I mean by taking a look at this chart from the Federal Reserve Bank of St. Louis's Buffett Indicator page, which I'll leave linked in the description below if you want to check it out for yourself. What this means is that we can't just use a simple set of criteria to make our trading decisions, such as buying and selling when the Buffett Indicator reaches certain thresholds. So what I did was detrended the data to eliminate that consistent upward trend by comparing the Buffett Indicator to itself from the prior year. I then looked at the standard deviation of that detrended dataset to determine how over or undervalued the market was at any given point. If the current valuation was at least one standard deviation above the average valuation, then I considered the market to be slightly overvalued. If it was 2 standard deviations or more above the average, I considered it to be significantly overvalued. And the same was true on the undervalued side. Based on the signal that the Buffett indicator was sending, I would have a hypothetical investor adjust their asset allocation, as you can see in this chart. What I found was that even though the Buffett indicator has historically been reasonably correlated to stock market returns, it, like most valuation metrics, has been pretty unreliable in terms of predicting major market downturns. According to the Federal Reserve's chart, there have been 7 recessions since 1971 when the data began. One of them began in 1973, 2 others in the early 1980s, one more to kick off the 90s, the dot-com crash, the Great Recession, and then this most recent downturn in 2020. Of those 7 recessions, by my count, only 3 were even sort of predicted by the Buffett indicator. Those were the 3 most recent recessions in 2000, 2008, and 2020. However, not all of them were without cost for our hypothetical trader. Prior to the dot-com crash of the early 2000s, a small markup signal was emitted as early as the third quarter of 1997. But that signal returned to normal by the third quarter of 1998, and remained there until 2001, when a big discount signal was emitted following the market downturn. Therefore, had you used the Buffett indicator to determine whether or not you were going to be adjusting your asset allocation, all you really would have avoided was fully cashing in on the 40% run-up in the stock market over the course of that year-long period when the Buffett indicator was suggesting that you should lower your stock allocation because the market was slightly overvalued. On the bright side, the Buffett indicator did tell you to buy the dip for the first quarter of 2001 to the second quarter of 2003, so that could have helped you balance things out to a degree. The Great Recession told a similar story, with a small markup signal being emitted as early as the first quarter of 2004, but it returned to normal by the second quarter of 2004 and remained normal until the summer of 2008, when a small discount signal was emitted following an 11% drop in the markets. So again, all you really would have avoided here was fully cashing in on the 8% run-up over the course of that quarter in 2004. But, just like it did in the early 2000s, the signals did tell our investor to buy the dip from the second quarter of 2008 to the third quarter of 2009. So again, there is some possibility of making up for lost gains via buying additional shares when they're on sale, given the depth and duration of the downturn. The downturn in 2020 was a bit different. The Buffett indicator did predict it, with small markup signals being emitted intermittently in 2013, 2014, 2017, 2018, 2019, and 2020, and a big markup signal was even emitted in the third quarter of 2020, which did not return to normal again until 2022. However, with one exception, every quarter that signaled a markup of either variety was followed by a gain in the markets. So there may not have been a whole lot to be gained at the end of the day from following the signals during most of this period, even if you would have softened the blow to your portfolio when the downturn in 2020 finally came. So, if avoiding the major downturns in the first place is the goal, the Buffett indicator, like most valuation metrics we've seen, doesn't seem to be the ideal solution here because it either misses the mark entirely, predicts a downturn that never actually comes, such as during the majority of the 2010s, or forces you to miss out on potential gains due to the lag between when it suggests adjusting your asset allocation and when the markets actually tank. Just for reference, here's a chart showcasing how an investor utilizing the Buffett indicator as a signal for trades performed relative to a simple buy and hold investor over this entire time span, as well as each of the recessions we just went over. Both investors started with nothing and invested $100 a month. As you can see, the Buffett indicator investor did technically outperform the buy and hold investor by a small amount over this entire time frame, assuming the buy and hold investor kept a 60% stock, 40% bond portfolio from start to finish, just like the Buffett indicator investor would have during normal market periods. The outperformance clocked in at roughly 0.54% over the course of nearly 50 years. However, that amount is so small that depending on the specifics of your financial picture, things like capital gains taxes as well as trading costs may well have been enough to bridge that entire gap. You'll also notice that despite successfully softening the blow to the portfolio during some of these crashes, the Buffett indicator investor didn't necessarily always outperform a simple buy and hold approach during these types of environments. Which raises the question that I mentioned really wanting to tackle at the start of the video. Why don't these valuation metrics work? I mean, logically, if the markets are overvalued, we'd expect them to revert to the mean and fall in value at some point in the near future. Or at least we'd expect the rate of growth to slow down for a little while until the valuation metrics fall back into their normal historical ranges, and vice versa for when the markets are undervalued. We know from stock market history that over the long term, the market's returns tend to be roughly the same from one period to another. For example, here's a chart showcasing the rolling 50-year returns for every possible 50-year period since 1871, per data from Yale professor and economist Robert Shiller. You can see that there is some variation, with a standard deviation of just 1.8%, but since we're looking at some 100 different time frames, I would have expected there to be a wider range than that if the returns did not ever revert back to some kind of long-term mean. So we can be reasonably sure that some sort of reversion to the mean is real, and yet the valuation metrics never seem to be able to beat the simple buy and hold strategies by any substantial amount, or with any substantial consistency in the real world. Why is that? I think there are a few possible explanations, and the real answer is likely a bit of all of them, depending on which metric you're looking at in particular. The first possible explanation is that the market is a living system. It adapts to new information that comes to light all the time. Because of this, a true, long-term, market-beating formula is very difficult to find, because investors adjust their behaviors to account for any insights it provides, which, in turn, changes the movements of the markets. In other words, the environment in which the hypothetical successful metric was created quickly ceases to exist. As a result of this, anytime anyone does find a strategy that works, they are incentivized to keep their findings under wraps, knowing that if they don't, their viability will quickly diminish. In other words, even if there is a metric out there that reliably works long-term, we're unlikely to know about it. Second, not all creations are honest ones. I've said it before and I'll say it again. There's a lot of money to be made in the business of money, and not everyone is going to try and make it in the most honorable way. In some cases, there are people who realize that their metric or investing strategy has no real long-term viability, but they still want to profit from it. So they use it to try and market something that they sell to other investors, some sort of investing secret, if you will, with the promise of greater investing success for anyone who buys into it. Unfortunately, this investing success rarely actually materializes because the metric wasn't the greatest from the beginning. This is why the seller was marketing it instead of using it to trade and profit for themselves. In other words, some of the metrics we do know of are basically dead on arrival, which means their only route to profitability is some sort of scam. And then there's a possible third reason, which is that people just get excited and share their findings. Not to try and scam anyone or do anything malicious, mind you, just because they're excited about what they've found. This often comes from people who are simply interested in finance and investing, or the math behind optimizing systems. It's that joy of discovery and learning new things that can sometimes lead to the creation or popularization of metrics and strategies that, in the end, turn out to not be very viable long term, either because they were overfit for a specific situation in which they were created, or just because the creator missed something about the markets that ended up leading to the metric's struggles, something that all of us are prone to if we're honest. So there you have it. That's the Buffett Indicator, as well as some potential reasons why so many of these valuation metrics are not as reliable in the real world as one would hope, based on what they're trying to do. However, just because these metrics aren't historically very reliable ways of predicting future market movements, it doesn't mean that they can't still be useful. Analyzing them can help us to mentally and emotionally prepare ourselves for potential upcoming market shifts. For instance, if the Buffett Indicator is rising above, say, 200%, which Buffett himself said is a level that would be playing with fire, we can't say that there's any guarantee that the markets are about to crash, but we can start to prepare ourselves for the possibility. We can take a moment to think through what we need to do with our budgets and our emergency savings in the meantime, as well as think about or discuss what we will not allow ourselves to do if a market crash does end up coming. So, yeah. They may not be the most useful things for predicting future market movements, but they can be useful in helping us to avoid shooting ourselves in the foot. And that is always a valuable perk. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.